Members of the SMSF Association, ladies and gentlemen, greetings and good wishes. I hope you're doing well in these difficult and trying COVID-19 related conditions. Thank you to the SMSF Association for the opportunity to talk to you today a little bit about. I'm going to speak for about 20 minutes and take you through a presentation, which will hopefully give you all the information you need. But feel free after that to get in touch with us directly on the contact information that is in the presentation, and we'll answer any of your questions that you may have. So I'm just going to quickly share my screen with you and take you through the presentation. Please give me a minute while I do that. Right, you should all be with me now, and hopefully you can see what's on screen. So just a little bit about me. My name is Alan Greenstein. I'm one of the co-founders of Zaga. I'm the CEO of Zaga Australia. I have a legal degree as well as a number of postgraduate diplomas and degrees, and have spent my life in banking. So I understand a little bit about the lending environment and the way that it works in Australia today. And obviously I've learned all the hard lessons, especially the one that says it's easy to give away money and much harder to take it back. So we're very careful in Zaga about how we lend in order to make sure that we get our clients' money back. So just in terms of the structure that we have, Zaga is an Australian private lender and investment manager. We funded in excess of $250 million, in fact now more than $300 million in first mortgage secured loans since we started business in July 2017. We hold a credit license and an investment management license from ASIC, our own credit license and our own investment license, which differentiates us from a number of the other players out there. And you can get a lot more information on our website, zaga.com.au. Our mission in life is to be a high integrity first mortgage secured investment business. And that means being a leading provider of mortgage secured alternative investments for wholesale and sophisticated investors who are looking to increase their yields without a disproportionate increase in their investment risk. We also offer creditworthy borrowers an opportunity for fast, flexible, and transparent funding across multiple loan types, as long as we can get a first registered mortgage over real property at a valuation that we're comfortable with. And to combine those two operations, we use an automated paperless proprietary lending platform with a matching algorithm within our business. And we also are able to offer that as a hosted solution for those parties who may wish to write their own loans and originate their own investments just using the platform. So how did Zaga come about? Well, we evolved out of the major market challenges, which have been with us for many years now, but which have obviously been also exacerbated more recently by COVID. And that is that the banks have significantly tightened up on lending. We have a number of asset-rich but cash-poor quality borrowers out there. Investor yields are very scarce, with the interbank rate now at an all-time low and the possibility of it going even lower. Those people who rely on investment income are finding it very hard to get a decent yield. And of course, there's this ongoing demand for income-producing assets. So we believe that the market was searching for alternatives, and we would like to believe that we can offer one of those alternatives. So when we started business, as I said in July 17, we realized an alternative asset class was needed to increase returns with mitigated risk amongst income-focused investors, especially those who manage their own portfolios, which is why we're talking to the SMSF Association. And we noticed that those who did manage their own portfolios were really clustered around three types of investment. But more importantly, what we noticed amongst self-managed super fund trustees and investors was that there was no real middle ground to their investment. They were either heavily overweight cash, which was earning a very low return, or they were overweight equities, which comes with its own series of risks. But there was not really much space in the middle for them to pad up their portfolios and to enhance the yield on their treasury type products, and to perhaps minimize or at least put a cap on the kind of risk that they would take on their equity products. We believe that Zaga offers that opportunity. So then just a little bit about Zaga so far. We received our ACL in October 2016 and our AFSL in February 2017. We finished the MVP part of our platform in May 2017 and launched our business a month later in June 2017. Since then, we've written more than $350 million of lending across more than 100 transactions at an average loan size of $4.5 million, and we have a current active book of $180 million. Investors would be pleased to understand that if they had invested with us since the beginning from our first loan, they would have had an internal rate of return well over 10%, which is very good for these circumstances, and a real rate of return of 8.95% per annum. That is at a loan-to-value ratio across the portfolio of 60%, which means there's lots and lots of room for comfort in there, and their investment would have rotated every 10.08 months, although we pay minimum interest on our investments to investors. So even though the average loan term is 10 months, if you would have been in a 12-month loan, you would have received 12 months worth of interest, hence the slightly higher IRR. We have incurred no losses to date. Every single investor who's been in one of our loans has received their principal and their interest back, and we have more than 300 registered investors, ranging from small financial institutions to property funds, to family offices, to investment managers, high net worth individuals, self-managed super fund trustees, and others drawn from both Australia and abroad. So just in terms of the investment landscape today, we know that COVID dominates all of the conversations. There's speculation that Australia is heading into a recession. We know that the interbank rate is exceptionally low at 25 basis points, and that the governor of the Reserve Bank Australia said in his most recent update last week that that could return even lower, and if they need to cut the cash rate even further, they would cut the cash rate to stimulate the economy. Banks are still very, very tight on new lending. Australia continues to import population, and as a result of that, there remains an undersupply of residential housing. The ASX has been exceptionally volatile, as have most world markets. And the problem you have is if you're invested in any of the markets is you always have timing risk. You don't make profit until you get out, and picking when to get out is exceptionally difficult. Property has consistently outperformed every other asset class over 10, 20, and 30 years, and there's plenty statistical information to back that up. It dominates most investment portfolios, and there remains, even in these times, an insatiable demand for property. So from a Zaga perspective, we see opportunity in adversity, and we think that lending against property remains a very strong proposition. Having said that, our job is not to outperform the market. We are not here to take all of your investment money and to get you the highest return you're going to invest. Our objective is to create an alternative asset class which you can use to further diversify your investment portfolio and which provides regular risk mitigated returns. We are conservative lenders. We understand who our investors are. We understand the kind of yields and returns they're looking for. And certainly we're not looking to be cowboys shooting the lights out in the saloon. We're here to be able to allow you to sleep at night, but knowing that you're getting a very, very decent return on your money as compared with the kind of return you would get in any other market type annuitized instrument. So just in terms of understanding that, we know that COVID-19 is causing a large increase in risk aversion and uncertainty. We've really seen that. We know that lower interest rates have been put into operation to help offset demand from the virus. The government stimulus package will provide welcome support to the economy. Combined fiscal and monetary policy should help us all navigate a very difficult period. And at some point in time, the virus will come to an end, although none of us can see into the future and predict exactly when that would be. The Australian banking system is very well capitalized and remains in an exceptionally strong liquidity position. And the Reserve Bank has said that it's not seen any particular sign of pressure in daily market operations. But it goes without saying that the global economy will be materially weaker in the period ahead. And with that in mind, one can actually understand the performance in the investment performance of the major asset classes. You can see there just that cash is at the bottom of that, which has performed quite poorly since January 2010, which is over a 10-year period at 2.9%. You can see there that US shares have been the best performing of that, followed by international shares and international property. But the difficulty, as I said earlier, for all of us is it's very hard for us to be invested in all of these asset classes. And also, that's a 10-year return. If you went into the market at the wrong time or you came out of the market at the wrong time, you're not going to make a return anywhere close to that. If you have been invested in Zaga for the last 3 years, you can see how your portfolio would have performed. And as I said earlier, you would have received something like just under 9% in clean yield, and your IRR on that would have been close to 11%. And if you look at that in the context of the international asset classes and local asset classes over their 10-year period, you can see that this is a very commendable and indeed very attractive performance under the circumstances. So just a little bit about Zaga itself, who we lend to, who we take money from, how we run our business. We lend to individuals, companies, and trusts, generally to asset-rich cash-poor investors, to owner-developers for their property transactions, to those kind of borrowers who the bank wants to help but is not able to help, generally because of the highly restrictive credit conditions and limitations under which the bank is currently operating, and to those people who need a quick answer on a deal that doesn't fit squarely within the bank box. So I think we all know that it's very hard to get a round peg to fit into a square hole when it comes to the banks, but we like to pride ourselves on having that ability to be sufficiently agile and flexible to make the round peg fit into a square hole, but without increasing any of the risk to those people who are funding the loan. Generally speaking, we best sum up our borrower profile as that these are not the loans that the banks don't want. They're rather the loans that they do want, but which they cannot do for any particular reason. And they revolve around property, construction and development, and commercial finance, ranging from land banking to construction and development deals, all the way through to cash flow and working capital finance and the like. As far as we see this becomes a triple play for investors, because via private lending and investing in our proprietary platform, investors can secure regular, consistent income. They can benefit from capital asset protection, and they can receive much higher returns than they would get from traditional bond or fixed income products. What's important is that we've tried to set up our business with an investor first point in mind. And in order to do that, we give protection to investors through a unique fractional investment lending trust structure, which we deploy across all of our loans. And that basically works as follows. We lend through a trust structure of which Zaga is the trustee. Every loan is held in its own dedicated subtrust, and inside of that subtrust are the members of the trust who are the funders into that loan, and each of those hold an interest in the trust, which is made up of the security in a fractional form. And it's that simple structure that allows absolute flexibility and transparency within the structure, and which gives our investors comfort that they can get access to the underlying security when they need it. So through that protection, investors' funds are never pooled. Their fractional share of the loan and the underlying security is protected by the subtrust structure. Each mortgage is individually registered in the name of Zaga Investments as trustee for the lending trust, and each investor gets their fractional interest as a member of that trust. There are a number of differences between Zaga's fractional structure and the classic special purpose vehicle or unit trust structure that is used in most of these loans. But I guess it really comes down to flexibility. We have fractional investment, whereas in the other forms of structure, it's really an equity investment. Ours is via a bare dominium fractional trust, whereas SPVs and unit trusts are through a corporate entity which are limited by shares or units. In our fractional trust, investors get direct see-through to the underlying asset as investment, whereas in an SPV or a unit trust, there is no such see-through. The relationship with our investors is regulated by the trust deed and an investor agreement, whereas in the other types of structures, these would be regulated by a constitution and a trust deed or a shareholders agreement. In the fractional lending trust structure, the investor or the investors can unseat the trustee and appoint a new trustee, but in an SPV or unit trust structure, you generally cannot alter your rights. The only right you have is to some kind of income or dividend stream. In our structure, the investors have fractional ownership over the mortgage. In the other structures, there is no such ownership or direct access to the mortgage. And our structure is highly agile and flexible, whereas other SPV or unit type structures tend to be highly rigid. So that, I guess, is one of the reasons why we've been able to attract the kind of investor base and support that we have, noting the uniqueness and flexibility and agility and protection offered by the structure. The investment process that we deploy is very similar. It's done via our website. It's a simple, straightforward process. It's neat, it's easy. An investor joins via the website. They then confirm their email address. They then register with us. Once they've registered, they customize their investment profile to make sure that we offer them the right loans. They don't give us any money until they see investments that they like. And only once you see an investment that you like and that investment is fully funded, do we ask you for the cash. And we generally only ask for that a couple of days before settlement. So we don't manage your money for you. We don't hold your money. You put in your money once you found the loan that you like. And we then take your money only a couple of days before we need to pay it into the lawyers to execute the loan and pay the loan away. As I said, all of that is done online. You get access to reporting, and I'll talk a little bit more about that in a few minutes. But the thing that I really need to emphasize is we can only deal with wholesale investors. And if you don't know what a wholesale investor is, there's a website that the ATO provides for you to do that. But by definition and default, if you are a self-managed super fund trustee, you are considered to be a wholesale investor. So as an investor, you can really have a choice of how you wish to invest with Zaga, directly into loans, which is what I explained on the previous slide, or via the Zaga feeder fund, which we use as a warehouse to get away all of our loans, and that is a pooled fractional investment structure. So for those who wish to invest directly, it means that you make your own funding decision every step of the way. Our algorithm matches you to a loan, or you find the loan on the platform. You decide whether you want to go into that loan, for how much you wish to go into the loan, as long as for not less than $100,000 each time, and you effectively determine the loan type and level of risk and return to which you are willing to be exposed for each kind of investment. And as I said earlier, if you had done that since inception of our business, you would have earned an IRR for yourself somewhere around 11% per annum, with no losses, almost no risk, at an LVR of 60% and for an average loan term of just over 10 months. On the other hand, we do get many investors who don't want to go loan by loan for whatever reason. They either don't have the time or the inclination, or they don't like the fact that it's first in, best dressed, and they may not get into a particular investment. And those investments effectively access portfolio diversification opportunities by investing in our feeder fund. That feeder fund has a minimum investment of $250,000. Your money is locked up for a minimum of 12 months, and we pay interest distributions 6 monthly. In July for the 6 months ended June, and in January for the 6 months ended December of each year. So if you wish to go into the feeder fund, you get exactly the same return to your loan as if you get in directly, but the feeder fund is cycling through all of the loans. The feeder fund may not be at 100% of a loan for more than 90 days. It must sell down the loan within those 90 days so that it holds less than 100% of the loan. There are many of our investors who invest both directly and through the feeder fund. There are many who come into one of those options only, sometimes switching between the two. But in all instances, investors must be sophisticated wholesale investors. The minimum investment size in the direct loan is $100,000, and in the feeder fund is $250,000. If you come in at $250,000 up to $1 million, there are certain fees that are payable. This is all explained in our documentation. And if you're interested in talking further with us, please feel free to contact us either at www.zaga.com.au or at info.zaga.com.au, or you can call me directly. My number is on screen. So from a Zaga point of view, we believe that we offer a conservative but nonetheless rewarding return on investment to investors who are looking for clean yield, who are looking for a transparent and simple investment structure, which offers them safe protection of their money, which offers them transparency and easy access to information, where the people who are involved in putting the loans together are all highly experienced, where the structure is fully regulated with 2 licenses by ASIC, and where we now have a track record of more than 3 years across 100 transactions and more than $300 million of origination. And with that in mind, we ask you the simple question, why zig when you can zagger? Thank you very much for your time today. A special shout out to the SMSF Association for allowing us to participate in this event with them. And we look forward to hearing from you should you be interested in talking to us further. Wishing you all well. Hope you all take care, stay safe, keep a safe distance, and look after yourselves. Thank you and goodbye.